Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Monday, May 11, 2015. Inside the numbers tonight, we're going to take a look at the SPY and the E-mini. A lot of stuff going on. We'll look at crude oil, gold, interest rates in the bond market, wild day in the bond market today, and then we're going to talk about the U.S. dollar and when that market should turn and how we can profit from it. So let's get right over to the S&P chart. This is the SPY daily chart, and have some lines on the chart. I know it might look confusing. We have a down sloping line here. I'm going to talk about that again in a minute. And then we have four horizontal purple lines, or fuchsia maybe. Then we have another line I put in here, and that was an intraday line, and I'm going to go over where that came from and how you can actually make an intraday trade and how you can pick out a level that should be good support and or resistance intraday to make an intraday trade if you so desire, if you're one of those intraday traders or like to try out the E-mini on for size, because that's a great intraday trading vehicle. So where are we? Here's where we are. S&P 500. So basically the bottom line is today was always going to be a turn day, but I wasn't sure whether we would go up into today and make new highs, new recent highs, or we would turn, down from the get-go today, and it was kind of an in-between. It was called a tweener, right? Let's go over to the 60-minute chart. Basically, the market started up today a little bit, made a high early in the day. That was at 10:30 in the morning. Then we melted away all day long. So that tells me most likely today is going to be a top. We may go up a little bit tomorrow, but I wouldn't think we would get to the highs from this morning at all tomorrow. I think that we put in a high for the week, and I'm looking for some downside pressure for the next several days. And where are those levels going to be? Well, you see this area right here. This is back to the 208.97. We know that number from before, right? We've experienced that number several times before. And this downsloping trend line is also going to be wonderful support. Now, let's go back to get a bird's eye view of what that looks like again. Okay. Downsloping trend line is if we can stay above this line, that's bullish. Below this line is bearish. If we were to get below the downsloping trend line, we would find temporary support at 207.50, 206, and 204. Those numbers hold true. Those numbers aren't going to change for the next couple of days, so we're going to keep those lines in there. I don't even need to adjust them. Now let's go intraday and where this brown line came from, and I'll show you how I derived it and what happened as a result of knowing that level, right? So let's go to the 60-minute chart. And what happened? Well, let's first go to the 10-minute chart, and I'll show you what happened. Okay, so intraday today, towards the latter part of the afternoon, the market came down and it pierced through that line. Okay, and this was a buy level. It was 210.61. 210.61 was a buy. We pierced through it all the way down to 210.52, and then the market rallied back over 211 again. Now, that doesn't sound like a lot to the average investor, the average trader, but 50 cents in a trade, 40 to 50 cents in a trade, when you're trading the E-mini contract, if you're buying 2 or 4 contracts, that's really an easy $4, $5, $6, $800 trade in a matter of 20 minutes. Okay, so I don't make light of those trades. Those are the bread and butter trades. Frankly, I make a living on those trades 2 to 3 days a week without question. So how did I know that level was coming? So I'm going to give you a little trade secret here, okay? Let's go over to the hourly chart, okay, and let's find out where that line came from. So early in the morning today, when we made that high, okay, at 10:30, I come over here with my Fibonacci retracement tool, okay, that most charting software has, and I take the low from the other day into the high, okay, and if I had the number on exact right now, it would be 210.61. In fact, let's just do it for the sake of it. Let's put the low where it belongs. Okay, low here was 206.76. Okay, 206.76. All right, and the high was 211.89. 211.89. Okay. And guess what? 210.61 is the number. 210.61. Let's go over to the 10-minute. It becomes a little more clear. Okay, you see this 210.61? So this line is where that came from. I did a Fibonacci retracement from the low from last week, from the other day. I think it was Friday's low, right? No, it was the 6th. Up to this morning's high. Okay, once I felt the high was put in for the day, okay, I determined that the market should find wonderful support at 210.61, which is the 25% retracement. And most charting softwares on the Fibonacci's will give you about a 23% and change retracement. I use 25%. I was taught that a long time ago. It works for me. It works more often than the other one as far as I'm concerned. So that's what I've used for years. And if this line didn't hold, then the next level of support would have been the 382, which was 209.93. Okay, but when the market is quiet, there was light volume. I figured that line would hold. You take a trade on a pierce below 210.61. 20 minutes later, you have a 45, 50 cent bounce. You're out of the trade, and that's a nice little profit for the day. So that's a little intraday trade and a little trade secret on how I came up with that number. Okay. I'm going to take it out, and I'll leave this line in because we'll probably open up somewhere on that tomorrow, and it may be deemed important for tomorrow. By the way, this was also into the 20-period moving average on the 60-minute chart. I mean, you had a trade set up here for a bounce. There's no question about it. And forget this last candle. Look at this bounce. Pierce it through, 20-period moving average, pretty good bounce, right? That was a good one. Okay, so let's move on. And you have my deal with the S&P. I think we probably made a high. Even if we do try and make some more gains tomorrow, I think those will fail. I think we're probably going to have downward pressure into or just before Memorial Day. That's my take on it. Okay, so let's go over to gold. Gold was weak. We didn't finish above 1184. I don't like that. It's not necessarily bearish, but it's not bullish. I'm going to wait for the chart setup to tell us what to do. Let's go over to the GLD. And look, remember this green line? Where did that green line come from? That's been in there for a long time. I don't talk about GLD every night with you folks, but look where that line was. See this pivot high? I drew that line way long time ago, and it was good support here. Okay, we broke through it, but it's served as good support here. Now we're down into it again. Do we hold it a third time? I don't know. I have to see it. Let the market prove itself. Is it going to hold a third time? There's just no way to know right now. We've got to see more. Let the market tell us what to do. There's no trade here right now. Oil, nothing's changed in oil. As long as we stay above the 58.63. I'm bullish on oil. A close first hourly and then daily below 58.63. I turn bearish. If we close below 57, I definitely turn bearish. But right now, we still could see 60.50. And if we firmed up and closed hourly above 60.50, then I'm still looking for 64. That's my take in the crude oil market. Nothing's changed. Same story. Bullish market until we close below 58.63 hourly and then daily. Nothing's changed, okay? Bond market got walloped today. Absolutely woodshedded today. I mean, this is an ugly, ugly sell-off. Look where we were. This is from the high on Friday, okay, at 157.10. This is the actual 30-year bond, all the way down to 153.5. This is just a thrashing today. Let's look at the TLT. Look at this market. Unbelievable. Let's look at the, I'm going to jump around a little bit on you. I'm going to the daily chart, and I want to show you something. Remember, I have this 123 line in here from last week. Remember what I said. You go back 4 or 5 days. Remember, we closed below that line, and I said that's bearish. And then the next day, we could not recapture the low from the day before. And I told you, I'm gone. That's bearish, and look what happened. That was at 120, let's call it, well, that was at 123 when I said that. Now we're at 119.5. That's a long way down in the TLT. It doesn't move that much normally, right? So where are we looking here? I'm looking lower. I don't like it. You might find support in here within the next dollar or so, but for me, I've got to see a new bottoming signal. So I'm actually looking down lower. and I'm going to look for a bottoming signal. I'm going to look for a doji. I'm going to look for a high volume day. And by the way, today was high volume, and maybe it was an exhaustion candle. That's possible because it was a big red candle that finished on the low with volume, but not high enough volume, not higher than these days from last week. Okay, so I'm looking for a high volume reversal day. Either we go down low, finish on the high, we have a high volume day that way, or a doji candle, something like that. So until we see the market telling us a signal that was a reversal day, we're not doing anything with the bonds. There's no reason to put your money at risk without a signal that the market reversed. We can come down all the way to 116. Who's to say we can't? The dollar. We're within the buy zone. We hit the low held. Okay, but I want to see us close above 95.35. Okay, in my book, we have to close above 95.35 in order to see more upside potential in the dollar. Okay, so we're watching one day at a time. Got to see that bullish picture form before we can really say definitively that a low is in place. I think it might be, it should be, but until it is, it isn't. All right. What was that number? Uh-oh, my mouse is dying on me. That number was 95.35. I've got to see the dollar finish above 95.35 in order to have that confirmation case that the bullish tone is in hand, right? That we're going to see more higher prices, more bullish nature, higher prices. All right, we're going to give it a wrap, but I want to talk one last thing. Copper. I mentioned copper about a week or so ago, and I want to just show you something. You got to understand there's a cycle top scheduled for June 2015, right? Next month. I don't know what day in June. We'll know it when we get there. But I have this line in here because this is actually a target. So if we see copper spike above $3, we're going to be very, very interested. There's a lot of chart resistance here. There's a lot of chart resistance up here. So anytime we get above $3, I'm going to start looking for signals that the market is going to top out or is topping out, and that we can ride it down from the cycle top in June. But remember, the market will normally and a lot of times trade into a cycle top. So I'm saying I'm expecting higher prices over the next 2 to 4 weeks, but I'm also expecting the market to show us a signal that it's topping for lower prices for the next several months. This is a monthly cycle top, a longer-term cycle top scheduled for June. So it's just something to be aware of. Nothing you can trade today, but something to put on the docket, something that we're going to want to trade when we see the market tell us the top is in. All right? I'm going to leave it there tonight, folks. A little bit shorter than normal of recent, but I gave you everything I had. Hopefully it's helpful. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.